Perfect. Okay, go ahead.
Progress.
I didn't want to start without recording. Good man.
All good, all good. So a brief intro about who I am and why you should listen to me if you feel like it. So for the last 7 years, I've been working as an engineer here in the US. About 4 years ago, I started a blog called The Best Interests. So for a while, I was an engineer and writer. I've had about 500,000 readers over the last 3.5 years, and have written for some websites that maybe you've heard of, CNBC, Yahoo Finance. And then more recently, for the last 3 months, I've been working for a fiduciary goals-based wealth management firm here. Fiduciary, if you're not familiar with that term, means that my firm has a legal obligation to work in our clients' best interests, which is something that's important to me. And so now I am a financial planner, financial advisor, and I'm still writing on the side. So really all of my work now is about helping people with their money. And as Dave alluded to, recently wrote a book called Money Mastermind with 30 other authors, some bloggers, some social media, personal finance influencers. So 30 authors, 30 chapters. We just passed 1,000 sales in a little less than 4 months. And I will throw this in the chat after I'm done. I have a discount code for everybody who's here, and we will be giving away a few copies of the book when I say my magic phrase. So let's go on. Uh-oh. Can you guys still hear me?
Yeah, we can hear you.
Can you? Okay. Sometimes my computer does this little hiccup, and but all right, we're going to get straight into it. Compounding. Now, I'm sure many of you are familiar with the concept of compound interest, the way an investment grows upon itself year over year. But I just thought I'd share some fun stories with you to help you think about compound interest. So there's this old Asian proverb where the inventor of chess was given a gift by the king who loved games. And the chess inventor, he said, "I'm just a game maker. The only thing I require in my life are chess and rice. So would you give me 1 grain of rice for the first square of the chessboard, and then 2 grains of rice for the second square, double that again for the third square, 4 grains of rice. And so for each square on the chessboard, if you're not sure, there's 64 squares, 8 by 8 grid. We'll just double the grains of rice for each square. That's the only reward I want." And according to the story, the king says yes, and he seals his fate because he doesn't really understand how compound interest works. So row 1 of the chessboard, barely even a meal's worth of rice. Row 2 ends up being about 3 pounds of rice. Okay, it's not exactly a big prize. Then you get to row 3, things start to change. Row 3, 750 pounds of rice. Row 4, we're only halfway through the board, and we've got 200,000 pounds, which is about what, 100,000 kilos if you prefer kilograms, 100,000 kilos of rice halfway through the board. By the time we get to row 5, we've got the mass of the Titanic, which is, a shared bond between Ireland and the US, the Titanic. Row 6, the rice is equal to the mass of all the cars on Earth. By row 7, it's equal to 10 times the mass of all the stuff on Manhattan Island, including all those skyscrapers. And by row 8, the rice is equal to the mass of Lake Erie, which is this Great Lake here. If you're not familiar with the United States geography, it's a big lake, and that's a lot of mass. So that's the prize that the game maker got for the, according to the story. And really, it's just a story to show how compound interest works. So it's not about money, but it should get you thinking about investing. A similar story here is Claude Monet. At least that's who I say is the story's about. He liked to watch lily pads grow on his favorite pond. If you're not familiar, Monet painted this particular pond many, many times throughout his life. And he notices that the lily pads, they double, the patch of pads doubles in size every day. So the pond, we're going to say, is a circle about 1 mile across. 1 mile is what, maybe 1.6 kilometers. And the question is, on what day is the pond half full of the lily pads? I guess I left out one important detail here. He watches it for a month. So he watches the pond for 30 days. And at the end of 30 days, the pond is completely covered. On what day is the pond half covered? Think about it, not sure. It's day 29. And once we explain it, it should make more sense. If it's 100% covered after 30 days and it doubles every day, then on day 29, that's when it's half covered, doubles to be full coverage on day 30. But again, we're going to examine this a little bit to understand how compound interest works. What we're saying here is that the first half of the pond, it takes 29 days to cover the first half of the pond. And then the second half of the pond, it only takes 1 day. So it's slow, 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 and then really fast. Another way of describing it, so I day by day here, you might have already read through these days. So on day 4, that's when the first lily pad finishes growing. By day 10, we have 100 lily pads, which is this tiny percentage of coverage. By day 17, we hit 10,000 lily pads, or about a 20-meter patch on a 1-mile pond. And by day 24, we have 1% total coverage of the pond. So the first 3.5 weeks, we get to 1% progress. And then the last week is where the other 99% of progress occurs. Compound interest, really slow at first, and then it just explodes. Okay. So that's idea 1 of the 7 fun ideas. Idea 2, we actually are going to get into some stock market specifics, and I call this one average versus actual. And one thing I noticed as I consume and read and write my own personal finance content is that lots of people like to talk about average stock market returns. Totally understandable, because if you're going to tell someone that they should invest for 10, 20, 30, 40 years, you want to explain to them what their average return might be over that time period. And a lot of times the average return ends up somewhere in the 5 to 10% range. Again, this is US biased. It might end up being a little bit lower, a little bit higher where you are, but somewhere in the 5% per year to 10% per year range, average. And I'll go back here 1 slide. That kind of looks like what we see on the left-hand side of the screen, where we have this nice smooth line over time, smooth curve. But the fact of the matter is that real life isn't average. So one thing I did with this particular chart was I wanted to understand, if I started investing, let's say in 1991, like I'm showing here on the x-axis, I start investing in 1991. What does my average return look like as I invest over 30 years? So I start investing in 1991. You can see my cursor. Let's say I'm here in the late 90s. I've been investing for 8 years. And over those 8 years, I've gotten about a 17% per year return on my investment, which is phenomenal. We said average was 7% or 8%, and here I am getting 17% per year. That's great. But then the dot-com bubble bursts. The 2000s are a somewhat lost decade. And then we have the great financial crisis at the end of the 2000s. And now here I am sitting in early 2009 down at this valley. I've been investing for about 18 years. And over those 18 years now, my average return is about 3% per year. Okay. Earlier, my average return was 17%. A decade later, my average return has dropped to 3%. That's how bad the market was over that time. So again, I'm not getting 7% or 8% per year. I've gotten 3% per year, and that feels pretty bad. Then we entered another bull market, and over the subsequent 12 years up until today, we get to the point when we have gotten to 8% or so per year, the so-called average. So if we really zoom out, yes, the average return was 8%, but along the way, we had highs and lows that were far different from average. So that's just emphasis again. The actual returns are far different than the average returns. And this plot here shows, yeah, I'll start with this plot. It shows the same exact thing as the last plot. It just shows it for 8 different 30-year periods, right? From the black line, 1920 to 1950, all the way up to the blue line, which is what we just examined, 1990 to 2020. You can see that some of these periods start really hot, like the white line here, but then they cool off over the next few decades. Other periods, like the red line, start pretty poorly. The 1970s start pretty poorly, but then a bull run happens and they end up somewhere around 5, 6, 7, 8% per year. They all end up in that range around 6, 7, 8% per year. And I'm reminded of this great quote from John Bogle, who was the founder of Vanguard and really one of the inventors, if you will, of index funds. He said, reversion to the mean is the ironclad rule of financial markets. Things that go up eventually trickle down. Things that start down eventually trickle up. And over time, you always revert to some sort of mean average, which is what we see here in this plot. Okay. If at any time, you guys feel free to ask questions. If we have questions throughout, I see I'm just not going to check myself. So again, Dave, if there ever is a time where you want me to stop and answer an important question.
Yeah, the question came in, Jess, from Richard there. Is this DCA, is this dollar cost averaging or lump sum, Jess? How are you?
Good question. Good question. I assume you're talking about this, Richard. This would be technically lump sum. This would be lump sum. It would look different if we were dollar cost averaging over this time, which is that's a good question. That's a really good question. I could make this chart again, assuming a lump sum. The reason why I'm hesitating a little bit, Richard, is just because I'm trying to rack my brain and remember how I made the chart, to be honest with you. I could go back and check the original article. This is an article on my blog called, actual returns will change the way you think about investing or something like that. So I'll go back and double check, but I think it is a lump sum at the beginning, then tracking how it performs over time. Next question or next section of 7, I call it the worst market timer. No offense to Mr. Bean. So imagine we have someone who buys the tops and only the tops of the market. So I call him Jim. He wants to invest. He just happens to have the worst intuition on earth. So he starts saving in 1990. He saves $5,000 per year. He increases his savings by 500 per year. So 5,000, 5,500, 6,000, etc. But because he has this terrible intuition, he happens to invest in August 2000. So he saves up his money for the 90s and then he pours it all in August 2000, right before the dot-com bubble burst. He feels bad about it. He starts saving money again. He doesn't really want to throw any more money in the market. He finally decides to pull the trigger in October 2007. October 2007. And then the great financial crisis happens. And then he does the same thing again, saves up money for 12 years, pours the money in right before COVID hits and the market crashes again. So the question I ask is, how much money does Jim have now? He's been saving for 3 decades. He picked the worst times possible to invest. How much money does he end up with? He ends up with about $800,000 after contributing about $400,000 over 30 years. So his average dollar has seen 4.2% annual growth. And that includes, all the ups and all the downs here. So it's not great. It's not the 7 or 8 or 9% that we'd hoped, but it's not terrible. And the reason why it's not terrible is because Jim never sold. He picked bad times to buy, but then he held his money even after the crash and waited for subsequent recoveries. You can see his portfolio here in the upper right-hand corner. He saves money in blue and then buys right before the crash. So here's his portfolio in red. His portfolio is below where he would have been if he had just been holding the cash. He does the same thing again at the end of the 2000s, the great financial crisis. Again, his portfolio is in red. But then over the last 12 years, his portfolio has eclipsed his total contributions to the point where his investment, again, it hasn't been ideal, but he's not in a bad place. We did have a question and potentially a comment that I haven't seen about dollar cost averaging. So if Jim had been doing dollar cost averaging since the beginning of the 1990s, he'd have 1.44 million instead of 800,000, or about a 7.7% annual growth rate, which is, again, what we'd hope that a typical index fund dollar cost average investor might get. I will take a quick pause because I did see more comments. Alvar, shared a link to right, dollar cost averaging versus lump sum investing. Yeah, one thing yeah, DCA means dollar cost averaging. So one thing to clarify here, there are a couple different definitions of dollar cost averaging, and they are important to differentiate. So the average investor typically does some form of dollar cost averaging, where they get paid every month and they put money into the market out of their paycheck. At least I call that dollar cost averaging. There's a set frequency, say once a month, and there's a set amount, $500. That's dollar cost averaging. There's another definition of dollar cost averaging that says, if I were to give you $100,000 today, would you throw it all in the market right now, or would you spread it out over time? In that case, throwing it all in the market at once, which is a lump sum, is historically has been a better practice than taking your time with dollar cost averaging. Okay, so in that case, dollar cost averaging is worse than the lump sum investing. But that's not the way that most people dollar cost average. Most people aren't given $100,000 to then spread out over time. Instead, they're just given a paycheck once or twice a month, and they take a little bit out of that and choose to invest it. That's also called dollar cost averaging. It's a great way to invest. And so I just wanted to differentiate that because I see some people talking about it in the chat, and just to explain my 2 cents on that difference there. Idea number 4 today is the stock market a casino? So it's a good question. I understand why people ask that question if investing is gambling, because we have things like the Robinhood app here in the upper right-hand corner, where you buy a stock and you get confetti coming across your screen, just like you're at a casino. We had meme stocks and weird cryptocurrency recently. That again is just huge sums of money being made and lost for obscure reasons, and it just feels like gambling rather than like anything rational. And sure, just the idea of making or losing money feels somewhat like a casino. But there's a really big, all-important difference in my mind between the stock market and a casino. Audio is low, says Frank. I'll try to stand a little closer to the mic or speak more loudly. So when we play roulette, the house is against us. Whenever we're at the casino, the house is against us. Sorry guys, I'm having a little technical difficulty here. Let me start over. When we're at the casino, the odds are against us. That's what I should say. The odds are against us at a casino. So if I'm playing roulette and I spin once, just I bet on red, I'm 47% to win, slightly worse than 50-50. If I play 10 times, my odds of having a winning record drop to 41%. If I play 100 times, my odds of having a winning record drop to 26%. The more you play, the worse you'll be. That's the way a casino works. But with investing, I've shown this chart here on the bottom, the longer you hold onto your investments for, if we look at the historical performance of, in this case, the S&P 500, the longer I hold my investments for, the more likely I am to win, right? If I hold my investments for 2 or 3 decades, historically, I've had essentially a 0% chance of losing money over that time period, okay? So in a casino, if you live 24/7 inside a casino and try to make money that way, you're going to go broke. If you live the rest of your life in the stock market and try to make money that way, you're probably going to succeed. Completely polar opposite ideas, okay? So let's go on to idea number 5, which I call luck versus skill. So I ran this stock picking competition through my blog. It went over 100 days. I had 100,000 people involved in the competition. On each day, I gave them a stock A versus stock B choice and I just said, which stock will do better today? If you had to buy one stock this morning, which one would it be? The best person who participated, they ended up with 71 correct choices and 29 incorrect choices. The worst person had 30 correct choices and 70 bad choices. And if I gave you all the chance starting today to invest your money with one of those 2 people, either the best guy or the worst guy, Who would you choose? Would you have a preference? I have a feeling that most of you would choose to invest with the best person, understandably so. But the real truth is I've been deceptive. I've deceived you guys here. This isn't a stock picking competition. There's no way I would have 100,000 people to participate in it anyway. This is just a simulation that I wrote with some computer software to represent coin flipping, 50-50 chances, complete luck, right? No skill involved. If you have 100,000 people flipping 100 coins each, you're going to have some coin flippers end up with 70+ correct choices and others with 70+ incorrect choices. It's going to look like there's skill. If I compare just these two people on this plot here, I would say, well, obviously the green person is doing something much better than the red person, but they're really just falling victim to luck. It's just luck. There's no skill. And so do some definitions here. Here we have Fire Dave. Thank you, Dave, for participating in these competitions for me. So Dave, I recently asked Dave to participate in both the Irish coin flipping championship and also the Irish chess championship. And he won both, which I think Dave deserves a round of applause for that. He won the coin flipping championship by successfully guessing 22 coin flips in a row. And he won the chess championship the same way. Every person in Ireland participated. There were 22 rounds, and Dave won 22 rounds of chess in a row. But my important question here is, do we expect Dave to win the coin flipping competition again next year? Will his talent there be repeatable? And similarly, do we expect him to win chess again next year? Is his talent there repeatable? I hope you'll agree with me that in coin flipping, it's dominated by luck, and luck is not repeatable. There's no telling if Dave is going to be able to flip coins that well again next year. But chess is a skill that is very repeatable. All the information is there, and the best players in chess always win. There's no luck involved in chess. So is Dave the favorite to win again next year? He's got to be up close to the top of it, right? If he was good enough to win 22 matches this year, he's still going to have that skill next year. Skill is repeatable. And now we get into why this matters for investing and for FIRE. So a few years ago, some MIT engineers, they wanted to understand how much luck was involved in different games and skills and sports and practices. And they did so by measuring repeatability. And what they found, as we might expect, coin flipping, 100% luck. Chess, 100% skill. Basketball, mostly skill. NFL football, American rules football, mostly skill, but some more luck than basketball. And then mutual fund management, which essentially is stock picking, was about 31% skill, 69% luck on their scale of luck to skill. In other words, mutual fund management had more luck involved than skill. Some skill, mind you. There's some repeatability to stock picking, but it's a lot more luck than people would admit. Okay, so it's an important idea here when it comes to stock picking is how much skill and how much luck is involved. It's more like coin flipping than it is like chess. Somewhere in between, but it's more like coin flipping. I'll pause at this point to check out three new messages. Okay. Craig, I saw you had a question about real returns. Yes, everything I've shown so far today have been real returns when it comes to the stock market. So for those who don't know, real returns means after accounting for inflation, as opposed to nominal returns, which means before accounting for inflation. So if the stock market goes up 15% and there's 4% inflation, my nominal return was 15%. My real return was only 11 because it's 15 minus 4. Okay, good question. And then I see Dave put buzzword bingo in the chat. Thank you, Dave. We're going to go on to number 6. And yeah, number 6, but the market is at all-time highs. You're right. So when would you sell? Would you sell your stocks if you were up 147% after 5 years and at an all-time high? That's pretty good. Would you sell your stocks if you were up 213% after holding them for 8 years? at an all-time high, that is a pretty good return. You might consider selling. What if you were up 500% after 13 years, again, at an all-time high? That seems like it might be the right time to sell. Well, which of these was the true high? Well, so far, I guess you might say C, but the real answer is these have all been points along the way from the bottom in March 2009 until today. This point here, after 5 years, that's point A. After 8 years, 2017, that's point B. After 13 years, 2022, that's point C. My point here being, guys, there have been so many all-time highs in stock market history. All we have to do is look at the last decade to see that. It's just a normal part of investing. You are going to hit all-time highs, and then the market is going to keep climbing from there. Of course, eventually at some point you hit the high from which there might be a 20 or 30 or 40% decline or crash, or the bubble might burst. That will happen eventually. But there are dozens and dozens of all-time highs before that point from which it makes sense to stay invested. If you had sold at point A because it was an all-time high, you would have missed considerable growth. Same thing for point B. Now here we are at point C. Maybe it is time to sell. I'm not really sure. And then that's really the idea that I want to get across here, is that I'm not sure. I doubt that you should be sure either, if that makes sense, right? A bunch of people were pretty sure at point A that they wanted to sell. They were wrong. A bunch of people were pretty sure at point B it was the time to sell. They were wrong. It's really hard to find the true all-time high. So here's a good chart on the left. This chart simply shows some tweets from some very well-known investing experts. All of these tweets are bearish in nature, meaning they're pessimistic. People are tweeting about a crash, the end game, ruin is on the horizon, sell everything you have and buy gold, et cetera, et cetera, et cetera. And the market just marches higher. The market just marches higher. Even with amazing godly timing, you can struggle to beat the market, because if you're not in the market, you're not getting any dividends, and there's no asset appreciation. Okay. So brings us to my final section here, which I call "You Can Beat the Market." And now some of you are probably crinkling your brows at me because we just talked about not trying to time the market, and we often hear this phrase like nobody can beat the market, especially from fire folks. There are some very well-known fire folks. I know J.L. Collins has been here on the Fire Dave live before. Mr. Money Mustache. There's some famous people who say you can't beat the market. Don't even try. I kind of want to crack that egg open a little bit because it's a silly myth. I understand why they say it, but I don't think it's the most accurate thing to say. I think there are better ways of explaining it, because the market is just average, right? When someone says, can you beat the market? What they really mean is, can you beat the average of all stocks in the market? And so imagine saying that you can't be taller than average, or you can't be smarter than average, or you can't be better than average. That's a somewhat silly thing to say. So of course you can beat the market, but there's a reason why this myth or this saying exists, because it's hard. It's hard to beat the market. So first, you might be paying investing fees, and investing fees are like starting a round of golf with a few strokes already on your card. You can still shoot under par from there, but the game just got that much harder. The second point, picking stocks is not a 50-50 exercise. And by that, I don't mean, what I mean is that, well, you can see the stats right here on the chart. 65% of stocks tend to underperform their index, and 35% of stocks tend to overperform their index. You can kind of see in the lower right of this chart down here, I put this little graph to kind of sort of explain what I mean. Stock performance has this really long tail where you have a few stocks that do so well that they drag the average up. But if you actually see where the average is, about 65% of stocks are below the average. And then you have some really, really high performers above the average that drag the average up. So in other words, picking winners is harder than picking losers. And then finally, we already talked about the whole idea of luck versus skill. beating the market for 1 year, okay, was that luck or was that skill? I don't know. Is that repeatable enough? If you can beat the market for 5 or 10 or 20 years, like Warren Buffett has done over his career, there's obviously some skill there, but it takes a long time to understand if you're just getting lucky or if you're actually skillful. So since it's so hard to beat the market, the question really is beating the market worth attempting, right? So I made some points here that I'll just rehash. It happens less than half the time. It's hard to repeat. Your fees hurt your chances. When you do beat the market, was it skill or was it just luck? If you're a DIY investor, like some of you probably are, is it worth your time commitment to try to beat the market? And then really, are you smart enough? And what I really mean is, are you smart enough about investing, about the real nitty-gritty details of investing? Are you smart enough to answer all these questions acceptably? So you add all that stuff together, and it's not about whether you can beat the market, because you can. The question really is it worth trying? And is it worth trying year after year after year after year? And the answer there is probably not. So thank you all for listening. If you want to get a hold of me, or if you want to check out some of my work, my blog is bestinterest.blog. We're approaching 4,000 people on the email list. You can email me, jesse@bestinterest.blog, or you can follow me on Instagram or on Twitter, where I've got, I don't know, I'm on Twitter a little more than Instagram, but I'm trying to grow on Instagram. So please, if you use one or both of those social media, give me a follow. I do appreciate it. And thank you all, guys. So I see, we've got some winners on Beat the Market. That's awesome. Some bingo winners. I don't think I missed a question, but I do from N Lawless. Would the really bad performers not drag down the average too? Yeah, that's a good point. That's a good point. So when it comes to stock performance, what's the worst that you can do? Let's say I buy 10 companies. Each one's at $100 per share. Where's the floor and where's the ceiling? That's the question I'd ask back to you. Sorry, I've got a bug in my throat or something. The floor is at 0, right? So the worst I can do from 100 is like the company can go out of business and stock can go to 0. What's the best I can do? There is no limit. I can double, I can triple, I can quadruple in price. So I could have 10 stocks that start at 100. Excuse me. 8 of them can go out of business. 1 of them stays at 100, and 1 of them goes to 1,000. Okay, 10 started at 100. 8 go out of business. 1 stays at 100, 1 goes to 1,000. The average price of those 10 stocks is now 110. Okay, the average is 110. 9 underperformed the average. 8 went to 0, 1 was still at 100. 1 that was at 1,000 dragged the average up to 110. If you picked that 1, you crushed the market. If you picked any of the other 9, you lost to the market. So that is a really quick and kind of simple example of what I mean. I hope that explained it reasonably well.
Jesse, thanks a million. Let me put my video on here. What a great presentation, a great introduction. Let me just clarify one thing. JL Collins was on January to kickstart the event, but we have not had Pete yet from Mr. Money Mustache. So in case anyone's thinking, but we welcome him, you know. No, fantastic. And so actually questions came in, but we are probably going to touch over. So are you going to stay on for the end Q&A, or how are you fixed?
So I'm sorry. Yeah, I have to catch a flight. So
cool.
I can stay on for about an hour if you want me to stick around, Dave, for that hour. But I have a feeling if the final Q&A starts after then I unfortunately I won't be able to.
Yeah, so I was going to say, how can people reach you? And I think you've given the information. So it was a good one. Beat the market. Can you beat the market? And I think, you know, that book is worth reading as well. So if people want to reach out to you, you've got the website. You've begun to Twitter. I'm not on Twitter myself, but you're on Instagram as well. So I suppose people can direct more questions to you that way, Jesse, right?
Excellent. Absolutely. I'm an open book too. I love answering questions from readers and fans. So send any question you have my way. Happy to help.
Perfect. Well, listen, thank you very much, Jess, and it's been a
All right.
pleasure to have you on. Thank you.
Thank you, guys. I will stop sharing, Dave, and let's see here.
Okay, I'm gonna pop you on mute for a second, and or if you can pop yourself on mute for a second, thanks, Jess. And we will just do a quick check. So look, we've got 29 or 30 people in the room now, which is great. There's more people joining. Welcome, Finn, Galaxy S8. I'm not sure who that is. We've got Helen as well. iPhone. We've got Mai O'Sullivan. Welcome, Rory as well, and Vincent. So look, we'll do maybe a bit of a recap at lunchtime, dinner time even at 8 o'clock on some of the presentations. But next up, I'm going to go straight into it and do an introduction and let's have a look. Before I introduce you, Alva, you're on the call. I see you there, good man.
Hey Dave, good to be here.
Good evening, Alva. So look, Alva is the host, has hosted the Financial Independence Europe podcast. And just to recap, Alva's buzzword is time. Alva has been pursuing financial independence for a number of years, that's fair to say, and will present on an introduction to FIRE, Financial Independence Retire Early, starting to invest in the stock market via different assets, ETFs, or I suppose investment trusts probably operate quite similarly, but good for an Irish audience. And I suppose top tips, would that fair to be say that you've picked up on your own strategy, building a decent portfolio in the stock market to reach FIRE. And I'm sure that you have a few golden nuggets in there for everyone. So good evening, Alva, and over to you, buddy.
Excellent, thank you, Dave. And I hope my audio is all right.
Yeah, you're good. Do you want me to hand host control and you can share your screen?
Please.